Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Shopify stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Shopify is an e-commerce company. It allows individuals or businesses to easily set up an online store and sell their merchandise. It also offers Shopify POS if you want to sell products in a physical location. Say for example, I make customized jewelry and want to sell my products online. I would go to Shopify and pay them a monthly fee so I can simply list my products on their platform. The monthly fee may be as low as $29 and up to $2,000 and possibly more with add-ons. If you want to make your website look really nice, there are lots of free and also premium templates to choose from. Their website is secure, so you do not have to worry about hackers or the site crashing. The great thing about Shopify is you can pretty much sell anything. You can sell a physical product and mail it to the customer, or sell a digital product that needs to be downloaded. The company offers retailers many different services, including payments, marketing, shipping, and customer engagement tools. The company has over 1.7 million businesses in 175 countries using its platform. They are in the top 10 of all publicly traded Canadian companies in terms of market cap. Shopify ranks second in market position behind Amazon. The company is headquartered in Ontario, Canada, and was founded in 2006. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 79 billion market cap. They're trading at $6.26 a share, and they have 126 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative free cash flow in 2018, a small positive in 2019, and then it's been growing after that up to $454 million in 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 18 and 19, positive in 2020 and 2021. Revenue is a sales for the company, and their revenue grows like no other, from $1 billion up to $4.6 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain their platform and websites is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that grew 4x from $600 million to $2.5 billion. Below that is their operating expenses. Their big operating expenses are marketing and research and development. Then below that is their operating income, which was negative in 18 and 19, positive $90 million in 2020, and then that tripled to $270 million in 2021. They receive $15 million of interest on their investments, and they pay less interest on their debt than that, so they have positive net interest of $12 million in 2021. Before 2020, they had pretty much no debt. They just started adding debt in 2020. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. And the reason they have such a big positive net income in 2021 was this large gain of $2.9 billion. This is their gain on investments in other companies. They own stock in a firm, and since that stock price went up, they have to report a gain here. But they didn't receive any cash. If they sell the stock, then they'll get cash. Plus, that's not part of their regular business. Their business is not to buy stock in other companies. Their business is their e-commerce platform. So I would ignore everything in other income and expenses. I would just focus on operating income when I look at the income statement. That's a much better indicator of how the company's doing. In 2020, they had $240 million of pre-tax income, and their net income was higher. They passed through a tax credit in 2020 because before 2020, they were carrying forward lots of losses. Now that they're finally profitable, they can benefit from those losses. This is the company's income statement from their financial reporting, and this gives us a little more detail than Yahoo Finance. This is 2020 and 2021. Of the $4.6 billion of revenue, subscriptions made up $1.3 billion, and all the other add-on tools were $3.3 billion. I like companies that can easily scale around the world. With Tesla, it's harder to scale. They have to build factories in those countries. Then they have to build cars. It takes a lot of money and time. With this company, it's really easy to sell anywhere. And their revenue is growing in every single area. In Canada, it went from 96 million to 316 million. In the US, 1 billion to 3 billion. In Europe, Middle East, and Africa, it went from 224 million to 800 million. Asia Pacific, 160 million to 470 million. Latin America, 21 million to 55 million. Their cost of revenue is 2.1 billion, so their gross profit is 2.5 billion. Their gross margins are pretty good, 54%. That's gross profit over revenue. That's in line with other companies in the industry. They spent 900 million in marketing, 850 million in R&D, 374 million in G&A. 82 million in transaction expenses and loan losses. They do supply loans to some of their customers. So their operating income is 268 million, up from 90 million. Operating income should be higher than net income, but in this case, it's a lot lower. It's mainly due to this large gain of 2.9 billion. They also had positive interest income. Usually a company would have a high interest expense on their debt. They don't. Their net margins are 63%, but we know this is artificially high. Their operating margins are 6%. That's operating income over revenue. And since operating income tends to be higher than net income, that means operating margins are higher than net margins. So if it wasn't for that large gain, their net margins would be pretty low. Because below operating income is the interest they pay in their debt, which wasn't much, but also taxes. So that would have brought down their net income below their operating income. These are not great margins. 6% operating margin, you would expect at least 20%. I know the company is still growing, so it does take time to build your margins. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see this makes a lot more sense. They had 500 million of operating cash flow. Last year was 425 million. Their revenue grew 60% from 2020 to 2021, but their operating cash flow grew 19%. And you can see how aggressive their operating cash flow growth was since 2018 to 2020. It grew more than 700% from 2018 to 2019 and grew more than 500% from 2019 to 2020. Maybe their day-to-day expenses were just a lot higher in 2021 relative to 2020. When I say day-to-day expenses, I mean R&D, marketing, payroll, things like that. And this is how you run your business on cash. And they spent 51 million in CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they started generating positive free cash flow since 2019. They issue tons of stock every year. Over 1 billion in 2018, 700 million in 2019, 2.6 billion in 2020, and 1.5 billion in 2021. They also added 900 million of debt in 2020. The idea is all these capital raises will help the company maintain its growth or even grow more in the future. This is their operating cash flow sections from their financial reporting. And the way you calculate operating cash flow, you start with your net income. You can see their net income varied a lot from 2020 to 2021, but their operating cash flows are very similar. Because in 2021, we had to add back that $2.9 billion gain. That was a non-cash item. It helped their net income, but it didn't help their cash flow. They also pay a lot of stock-based compensation to its employees, 331 million. When they give out company stock to their employees, it doesn't cost them anything, but it does dilute the current shareholders. We also have to adjust for changes in working capital. So even though they reported a gain of 2.9 billion, they actually generated $500 million of cash flow. Two important numbers I like to look at are revenue and cash flow from operations. These are those two numbers since 2015. So you can see their revenue grew slowly until 2019, then it just took off. Their operating cash flow was straddling break even through the beginning of 2020. Then it grew a lot, and it's been pretty flat in 2021. The projection is for their revenue to continue growing a lot. This says by the beginning of 2025, their revenue should be 11 billion. The revenue in my model is pretty close to 11 billion. And it does appear the operating cash flow should be flat through 2024. Then in 2024, it'll start growing. This is their investing and financing sections from their statement of cash flows. Since they have so much cash from all the capital raises, they buy a lot of marketable securities. These are short-term investments that are highly liquid, like CDs or commercial paper. They bought $7 billion in 2021, $6 billion matured. They purchased $650 million of equity and other investments. An example of this is common stock in another company. They bought $51 million of property and equipment, and they spent $60 million in business acquisitions. So in their investing section, they had a cash outflow of $2.3 billion. Last year was a cash outflow of $1.9 billion. And they do issue lots of stock. They raised $1.5 billion from stock issuances, $2.6 billion last year. And last year they raised $900 million of convertible notes. So in their financing section, they had a cash inflow of $1.6 billion. Last year was a cash inflow of $3.6 billion. Let's look at the equity section on their 12/31 balance sheet. They have $11 billion of equity. They raised $8 billion from selling common stock, and they profited $2.9 billion from running their business. But we know most of this retained earnings number is from that large unrealized gain, because retained earnings is a sum of all your prior net incomes. Last year, their retained earnings was only $15 million. They're adding new merchants at a 41% CAGR. In the fourth quarter of 2021, they added over 100 million merchants. And that number has been growing every single quarter. So it's really impressive growth. Adding so many customers and charging them fees is great, but are those customers getting value? The way we can figure that out is look at the GMV, the gross merchandise volume. These are the total sales from all the customers on their platform. And that grows a lot every year as well. $175 billion in 2021. Let's look at the capital structure. $11 billion of equity, $1 billion of debt. They're 90% equity, 10% debt. And they could pay off all the debt with the cash on their balance sheet and still have $6.6 billion of cash left over. This blue line is the equity balance since 2015. The red line is a debt balance, and the green line is a cash balance. They just started adding debt in the middle of 2020. They had no debt before that. And their equity balance was pretty low for a while, but then they've been adding a ton of stock the past couple of years. Now their equity balance is close to $11 billion. They have a really good capital structure, but that's mainly because they've been issuing so much stock. When they start to become really profitable, that's when you'll know they have a successful company. And I gave them the lowest WACC of 6.24%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 7, that's $65 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $50 billion. We divide that by 126 million shares. And we get a calculated stock price of $400. They're trading at $627, so they're trading at a 57% premium. It's a sell according to the model. The last time I did a video on this company was in December of 2020. They were trading at $1,200, and my valuation was $722. And surprisingly, they came down below that valuation number. And the reason my valuation is a lot lower than it was last time, because the company revised its future projections. They're expecting growth to be not as strong as they thought it would be. Their revenue growth is projected to be 22%, so I grew their revenue 22% for the next 7 years, which I think is a pretty aggressive growth. That means they would hit $18 billion by 2028. Their annual growth now is over 50%. So I definitely don't think they can grow at 50%. That would be pretty amazing. But if they continue growing at 50%, the stock price will get back up over $1,000. And to figure out their future free cash flows, in 2020, they converted 13% of their revenue into free cash flow. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. They converted 10% of their revenue into free cash flow in 2021. I am trying to give them a higher valuation because my number came out so low. I gave them the lowest WACC and also converting 13% of their revenue into free cash flow. And I'm still coming out with a stock price a lot lower than they're trading at. Simply Wall Street's valuation is $420. They're also saying the stock is overvalued. 28 analysts priced this stock and the average price target was $1,000. The low was $800, the high was $2,000. This is where the stock has been trading the last 2 years. It took a huge fall recently. When a stock comes down so much, I usually think of two reasons why. One reason could be the market is crashing and everything is coming down. There's a lot of fear in the market. That is partly the case. The market is coming down, but it's not a crash. It's not like it was in March 2020 or in 2008. Some stocks have come down a ton, but the overall market is not really crashing. Another reason the stock price is coming down so much is because maybe it should have never been that high in the first place. Maybe it was just overvalued and now it's coming back down to reality. Then maybe you would not want to buy the stock. But if you feel when the stock price was getting close to $2,000, that's where it belongs, then this is an amazing value for you. They have a beta of 1.55, so the stock moves about 1.5 times the market. It's a bit volatile. It's gone down 50% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 624, the high is 1762. And the stock is on a major decline, trading below its 50-day and 200-day moving average. 2 to 3 million shares are traded each day. Almost all the shares outstanding are on float. 72% are held by institutions, and about 3.5% of the shares on float are shorted. Their employee count has been growing as much as their revenue has. They currently have 10,000 people on staff. If you invested $10,000 into this company when they started trading, even with the big decline, you'd be at $244,000 today. That's a 60% annual return. But at one point, you would have been close to $600,000. In the past 12 months, there's been no insider buying, just selling. Every quarter, there's some selling. Here's a list of all the insider sells, the date, the person, the shares, and the amount. So I'm sure all these people are really happy. They saw the problem before it occurred. They all sold for well over $1,000. 67% of the shares are held by institutions, 27% by the general public, and 6% by insiders. The founder and CEO owns 6.27% of the company, 8 million shares valued at $5 billion. Then Capital Research, Bailey Gifford, Morgan Stanley, and Jennison Associates. Let's look at their financial ratios. All their price multiples have improved a lot since the stock price has come down so much. Their PE is 27, but that number is pegged off of net income, and we know their net income is artificially high. So that's probably not a good number to look at. Price to sales is a good number to look at. That's 17. That's stock price over sales per share. That's worse than the market median and market average. At the peak, their price to sales was about 55. Now it's trading at 2017 levels, and their revenue is much higher than back in 2017. This chart implies that the stock was extremely overvalued, and now it's trading at the appropriate level, or at least where it was in 2017 if you feel it was appropriate back then. Like I said earlier, if you feel trading at 50 times revenue is the right level for this company, then the stock is trading at a huge bargain at 17 times revenue. I think it's trading a lot closer to where it should right now. I think it was extremely overvalued back then. When a company is trading at such a high multiple, then that implies their growth should be enormous. When a stock is trading at a lower multiple, 17 is not low. Below 5 will be low, but 17 is low for this company. So when a stock is trading at a low multiple, their future revenue growth shouldn't be as dramatic as it was when they were trading at 50x. So if you don't believe the DCF model, then I think this should imply the stock was extremely overvalued last year. And their price to book is 7.1. That's stock price over book value per share. Let's look at their non-current assets. 100 million of property and equipment, 200 million of right-of-use assets. This is when a company leases or finances an asset that's owned by another company, like a factory, for example. 139 million of intangible assets. This may include computer software or trademarks. 48 million of deferred tax assets. This will help reduce the amount of taxes the company pays in the future. 356 million of goodwill. Goodwill is the premium you pay when you acquire another company. And they have 4 billion of equity and other investments. Equity method accounting is usually used when a company owns 20% to 50% of another company. Of the 4 billion of equity investments, 3.2 billion is readily determinable fair values. This is probably common stock because you can easily determine the value of common stock. Just look where it's trading. 540 million where they cannot determine the value. This is probably ownership in a private company. And 200 million of debt. They didn't actually buy common stock in another company. They work with the company, a firm, so a firm gave them stock in their company. Affirm is the company that prematurely released their earnings on Twitter, and I'm sure someone got fired for that. They deleted the tweet, but people screenshotted it and the information got out and the stock tanked after hours. Let's look at their non-current liabilities. They have $162 million of deferred revenue. This is when a customer prepays for their monthly subscription. Say they pay for 2 years up front. Shopify cannot book that revenue until the 2 years are complete. So they carry it on their balance sheet as a liability. Then each month take a portion of that dollar amount off their balance sheet and book it as revenue onto the income statement. They owe $247 million of lease liabilities. This could be the lease payments for all its corporate locations. $910 million of convertible notes, so they have to carry these notes on their balance sheet. If the stock price goes up a lot, then the holder of the note will convert that debt to equity and they'll get shares in the company. That's the ideal situation for Shopify because they remove that liability off their balance sheet, although it does dilute the current shareholders. And they have $183 million of deferred tax liabilities, so this will increase their tax bill in the future. They have a really high current ratio and quick ratio above 12. Let's look at their current assets: $2.5 billion of cash, $5.3 billion of marketable securities, $190 million of accounts payable. This is how much money other companies owe Shopify. They provided $471 million of loans to its merchants. This is an asset because they're owed money. If they took a loan, then it would be on the liability section. And $100 million of other. Let's look at their current liabilities. $456 million of accounts payable. This is how much money Shopify owes other companies. $217 million of deferred revenue. So deferred revenue appears in current liabilities and non-current liabilities. Let's say someone signed up for Shopify and paid for 2 years up front. That means Shopify has to carry that revenue on their balance sheet as deferred revenue. Anything in current liabilities are financial obligations owed within 12 months. So if a customer paid $2,000 for 2 years of service, $1,000 would go into the non-current liability section and $1,000 would go into the current liability section. And each month the customer uses the service, Shopify would remove a portion of the deferred revenue in the current liability section and book it onto the income statement as revenue. They generated $454 million of free cash flow in 2021, and they have $7.8 billion in working capital. They appear to be well capitalized, so they probably could avoid doing a capital raise in 2022. The best way to look at ratios is to compare them to companies in the same industry. There are 248 companies in the same industry as Shopify, and Shopify ranks 6th in market cap. If they have a number in blue, they're better than the average. If they have a number in red, they're worse than the average. It's hard to compare some of the numbers like free cash flow. Of course it's better than average because there's so many tiny companies in this industry, it really drags down the average. The price multiples are the best way to compare companies. Their PE is better than average, but if we stripped out that large non-cash gain, their PE would be terrible. And I cap these ratios at 100 because I've seen PEs in the thousands and it makes the average look ridiculous. So that's why I cap it at 100. Their price to free cash flow is worse than 100. That and price to sales are the most important ratio. You can rely on these two ratios a lot more than PE. Even though their revenue is really high, $4.6 billion, it is worse than the average company when you compare it to the market cap, because price to sales is market cap over revenue. And the reason the stock got so high was because of their growth rate. It's just unreal, 63%. And there's almost no chance of their growth continuing at this rate, and even the company said that. To summarize, I have them trading at a 57% premium. I do really like their business model, and I think there's a decent chance they'll get back up to where they were in 2020. I think that may take a really long time. But each quarter we get more information with their newest financials, so check back in next video after they report their 3/31 financials. I ranked their free cash flow 7 out of 10, their revenue 9 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.